I had this whole day planned. I was not going to sit down and make a ratio video. I was going to do something completely different. And then I looked at the gold-silver ratio again and realized we were right back in one of those zones that keep showing up every decade or so. The kind of zone where people either get very smart very slowly or very emotional very quickly. And now here I am because this is one of those topics that sounds simple on the surface but becomes extremely useful once you actually understand what it means and what it does not mean. I am recording this right now from Los Angeles, and I want you to comment what day and date you are watching from, because ratio extremes are all about context, and I always like seeing when people caught the setup versus when the market finally moved. And real quick, if you value this kind of practical, level-headed metals analysis, do me a favor, subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now here is the claim making the rounds. The gold-silver ratio is at an extreme. Therefore, silver is guaranteed to massively outperform from here. On the surface, that sounds obvious because people love mean reversion stories. But when you slow it down piece by piece, you realize the ratio is incredibly useful and still easy to misuse. That is not the whole story, not even close. Because the first place these stories usually get weak is when people treat the ratio like a timer instead of a framework. The ratio can tell you that silver is relatively cheap versus gold. It cannot tell you the exact day the market decides to care. So I am going to break down three things. First, what the gold/silver ratio actually measures in plain English. Second, what tends to happen historically when the ratio gets stretched to extremes. And third, how to use it without turning a good framework into an expensive emotional trade. You are going to walk away calmer, sharper, and much more in control of your metals positioning. So let us start with what we can verify. The gold-silver ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. That is it. Clean. But the interpretation is where people get messy. When the ratio is high, silver is relatively cheap compared to gold. When it is low, silver is relatively expensive compared to gold. Here is the clean way to think about it. Gold is the steadier, older sibling. Silver is the awkward cousin of gold that shows up to the family event, does something wild, and then disappears for a while. It does not glide, it lunges. That is why the ratio matters. It is not comparing two equally behaved assets. It is comparing a calmer monetary anchor to a more volatile hybrid asset that is part monetary metal, part industrial chaos machine. Now here is what nobody wants to say clearly. A high ratio does not mean silver must outperform immediately. It means silver is statistically and historically living in a zone where outperformance becomes more plausible if the macro backdrop helps. The ratio is a map, not a trigger. It points to relative value, not guaranteed timing. A correlation is not a contract. Stay with me on this because it matters. Think about plane altitude from runway versus sea level. If one pilot says we are low and the other says we are high, the first question is low relative to what? Sea level? Runway? The gold-silver ratio works the same way. A ratio can look extreme relative to the last few years or less extreme relative to a full multi-decade range. Reference points matter. Down from what? Up from what? Same number, very different meaning depending on where you frame it from. Now here is the skeptical alternative. Could the ratio stay elevated for longer than people expect and make silver bulls look early again? Absolutely. I am going to say something that might annoy both sides. The ratio can be screaming relative value, and silver can still disappoint for quite a while if gold stays strong for monetary reasons while silver lags because industrial demand is weak or liquidity conditions are bad. That is plausible here, is how it can fail. People who worship the ratio in isolation forget that silver has two personalities: monetary metal and industrial metal. If the world is worried enough to buy gold but not healthy enough to reward silver's industrial side, the ratio can stay stretched. That does not invalidate the framework. It delays the payoff. Here is a question for you. Do you think silver's next outperformance move will happen because gold stays strong and silver catches up, or because gold stalls and silver suddenly surges on its own? Drop that in the comments because I read them and it tells me whether people are thinking relatively or absolutely. Now let us talk about what tends to happen historically when the ratio gets extreme. The pattern is not that silver instantly explodes every time. The pattern is that the probability of silver outperforming gold over the following stretch improves meaningfully when the ratio is stretched enough and the macro backdrop cooperates. In other words, this is a swap framework more than a moonshot prophecy. If you already own gold, a high ratio can be a signal that swapping some gold into silver may make sense for a portion of your position. Not because gold is bad, not because silver is guaranteed, but because the relationship between the two has become unusually tilted. Let me be blunt. This is where a lot of people overcomplicate things. They wait for perfect certainty. There is no perfect certainty. The useful question is not, is the ratio calling the exact bottom in silver? The useful question is, has the relative setup become attractive enough to justify a measured shift? That is a much better way to think. Now here is the skeptical counterpoint again. Could a ratio-based swap strategy still underperform? Sure. If gold keeps leading and silver stays weak, the swap hurts you for a while. That is plausible here, is how it can fail. If your time horizon is too short, or your sizing is too large, or you make the swap emotionally instead of gradually, a good long-term framework becomes a bad short-term experience. That is why time is the weapon here. The ratio favors patience, not impulsiveness. If you want to understand whether the setup is ripening, you do not just watch the ratio itself. You watch the ratio, silver's price structure, and the macro environment together. Ratio stretch, technical stabilization, macro breathing room. Those are the three tells. If you only have one of them, slow down. Tell me in the comments, are you more comfortable owning gold, owning silver, or actively swapping between the two when the ratio gets extreme? I want to know because this is where personality matters almost as much as analysis. Now here is a simple action plan. No drama. If you are a stacker, here is your rule. Do not dump one metal for the other all at once just because the ratio got your attention. Scale. If you are a trader, here is your rule. Define your entry, your ratio threshold, your invalidation, and your size before touching the trade. Write it down. If you are building long-term, here is your rule. Use the ratio as a rebalancing tool, not as a religion. Decide this first, then act slowly. Do not make the common mistake of treating a relative value framework like an urgent, all-in event. Another part of the action plan is emotional discipline. Gold feels safer. Silver feels exciting. That emotional difference is exactly why the ratio framework is useful. It forces you to think in relative value rather than comfort. But keep it sane. Silver does not need leverage to be exciting. It will provide the excitement for free. Now let us map two plausible paths without pretending we can predict the exact candle. Path 1 is the classic catch-up path. Gold remains firm, silver stabilizes, and the ratio begins to compress as silver outperforms over the next leg. In that world, The extreme did what extremes often do once the backdrop allowed it to. I am not predicting it. I am saying it is within the set of things this market is capable of doing. Path 2 is the frustrating extension path. Gold keeps acting like the cleaner monetary hedge while silver lags because industrial demand or liquidity conditions stay soft. The ratio remains stretched longer than people expect. Both worlds can be true. That is why the ratio is a framework, not a stopwatch. Now here is the uncomfortable truth. A lot of people say they want to use the gold-silver ratio intelligently, but what they really want is for the ratio to give them emotional permission to make one dramatic move and feel clever immediately. That is not disciplined portfolio management. That is performance theater. Real ratio work is slower, calmer, and usually much more boring than people want it to be. And because it is boring, most people do not do it well. Here are the 4 rules. 1. Decide your maximum allocation first. Write it down. If you are losing sleep, you are too big. 2. When something runs hard and you are up a lot, take some off. Not all. Some. If your position doubles, consider trimming half. Lock in the original bet. Let the rest run. 3. Do not use leverage on silver just because the ratio makes the relative case look strong. 4. The best time to buy is not always when you are most excited. The best time to buy is when you can still breathe. So here is what we covered. The gold-silver ratio measures relative value, not timing precision. High extremes make silver outperformance more plausible, not guaranteed. The ratio works best as a rebalancing framework, not a prophecy machine. And the investors who use it best are usually the ones who act the least dramatically. Stay thoughtful. Stay patient. Do not let a useful tool become a bad excuse for emotional trading. Now here are my questions for you. At current ratio levels, are you adding silver, holding gold, or swapping some gold into silver? And do you use the ratio as a real portfolio tool or mostly as a market curiosity? Drop your answer below and remember to include what day and date you are watching from. If you got value out of this, subscribe and comment FinTalk OG so I know you want a follow-up when the ratio either compresses or stretches even further. And if this helped, share it with someone who keeps talking about silver being cheap but has never defined what cheap actually means. Stay thoughtful, and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation, and if you need personal advice, get it from a qualified professional who knows your situation.